For 2017, I guess the consensus in a sense has gone wrong, but for 2018, the consensus believes that there is a 7 to 8% upside coming for benchmark indices. Let's take the conversation forward with Anant Shirgaonkar. Anant Shirgaonkar is Managing Director and Partner with Newport Capital. Anant, fantastic to have you back and thank you for joining us.
Thank you.
Well, the consensus believes that there is 8-9% upside coming for the index for 2018. Now, I think that's a very conservative number, isn't it? Looking at the fact that we are sitting on the cusp of an earnings recovery.
Yeah, I think that would be a fair statement. Basically, what is happening is we've seen last 2-3 years wherein people have been expecting earnings growth to come by, but it hasn't really come through. That psychologically puts you on the back foot. When you project the earnings for the next year, you actually lowball the whole thing. That's where the big risk lies in terms of going wrong. Because when the earnings come back, they don't really come back in a tepid manner, right? They really flow through. And there's a lot of operating leverage, financial leverage is built in. When that starts playing through, I think some of these sectors can actually just show massive earnings growth. And we started seeing that in some of the discretionary names already. I think we could see more of that, and therefore we could see when the earnings come back, they could come back much more robustly than what is being projected.
So how long before earnings from consumer discretionary flows through to other sectors? Is it a wait of a quarter, 2 quarters, or longer?
No, so I don't see, that's a very tricky thing to do, but the point is it's better to anticipate some of these things rather than try to forecast saying this is going to happen 2 quarters later and therefore I will jump into this sector after 2 quarters and then three quarters later I'll jump into this sector. So better idea is to look at some of these sectors which were beaten down, wherein the earnings expectations were so low that from there you can only expect upside, which is where consumer discretionary qualified, say 2 quarters ago, alcohol qualified, say some QSRs qualified, and all of them started showing earnings growth. Stocks have done very well since then. I think this is just the beginning for some of these names. You should identify some similar sectors wherein the expectations are low, everybody is looking somewhere else, and you could actually see earnings growth expectations being beaten in some of these sectors which everybody is neglecting.
So let's talk
would you be worried about changing macros? Like we were discussing earlier on today, with now crude getting back to 2015 highs, the fact that that's going to dampen inflation going forward, the RBI may be stalling interest rates from here, if not an uptick is what we can expect. Is that something that would worry you at all?
I don't think that's something to worry about right now. Basically, see, the way it will play out is at any point in time there will be some macro worry, right? So at some point in time it would be coming out of the US or out of Europe. Sometimes it comes out of crude and commodities. Sometimes it will come out of RBI. I think a better way to look at things is bottom up and look at stocks which will show earnings growth in spite of all of these. And there are enough sectors and stocks to look at. I don't think I'm really worried about crude and RBI starting the interest rate hike. I don't think any market has ever topped out after the first interest rate hike, right? We have to see the full cycle play through, wherein corporate leverage increases, the borrowing goes up, RBI increases rates subsequently, inflation peaks out, and that's where you should start worrying about the markets. I think at the first rate hike, I think it's way too early to worry about RBI hiking rates and its impact on the markets.
You like ACC for 2018. Now, ACC is a cement company but a very expensive stock to own.
Yeah.
Why go for the market leader? Why not go for a regional player? Because cement is not an all India player.
Yeah.
It is a regional player.
Yeah. So the way I look at it is quite often people talk about South is going to do well or East is going to do well, but it's very easy to go wrong on some of these things, because when you say South is going to do well and that becomes a consensus view, it also gets baked into the stocks which are based in the South. So I always wanted to look at pan-India plays. I'm okay to make lesser returns, but I don't want to go wrong on one particular region and then not make returns out of it. So I'm happy with the pan-India play like an ACC.
I'm quite surprised that you're bullish on logistics, because about 3 years back when the Amazons of the world were just about gaining traction in India, that's when this sector was hot, and even then I would say it just about took off before it crash landed.
Yeah.
And what makes you bullish? Because most of these companies are now getting in their own logistics model, at least Amazon is, which was supposed to be the biggest play and biggest revenue generator for the logistics business. Why logistics then?
So I think what the way I look at this is logistics is not only going to be an e-commerce play. We'll come to e-commerce in a bit, but more importantly, what drives it is going to be your economic recovery. So logistics has gone through two pains. One is the demonetization, after which the economy really froze. And at that point in time, we started approaching GST. And I think the consensus wrongly got it saying that GST biggest beneficiary is logistics, without realizing that GST can actually freeze the flow of goods and adversely impact logistics, which is what happened in 2 quarters. And now nobody's talking about logistics, which is where I think the opportunity comes in, wherein if the economy is recovering now, the negative effects of demon and GST are behind us. I think logistics plays will start showing volume growth, and they will start showing earnings growth followed by it. So it's basically a high leveraged economic growth play. And I think the timing seems to be much better now rather than 1 year earlier.
Any specific names within logistics that you're betting on? And if you could talk about those?
So I think so the two things that I'm looking at. One is the global leader in logistics, which is going to be the big. So in air cargo, it benefits the most. In domestic, it benefits with 17% market share. So that's a no-brainer. There's another name which I like, which is the warehousing company, which sort of helps in freezing and keeping goods at the right time. Again, this was very, very adversely affected because of GST, and the utilization levels really cracked. I think now the GST effects are going behind us. Utilization levels have started inching up. I think you will start seeing utilization inch up quarter after quarter. That's what will cause, I think, exponential growth in earnings.
But logistics stocks aren't entirely cheap. I mean, I look at Blue Dart. It's got a P multiple which is crazy.
Yeah.
I think 40, 50 times.
Yeah.
If I look at even something like all cargo, since earnings are not there, the P multiples are looking bloated. Gateway District Parks, a pure play on the so-called global trade. Again, P multiples are slightly out of whack.
Correct.
Mahindra Logistics just went public. It's not got a response also, even though it's a third-party venture. Future retail IPO or future logistics IPO has come and gone, and no one's talked about it.
Yeah. So I got the same pushback when you looked at alcohol, say 2-3 quarters ago. So when the earnings are depressed, stocks will look expensive. The only call you need to take is whether the earnings are going to come back and come back ferociously over the next 2-3 years. Same pushback was with the pizza company, with numbers not flowing through. But when the numbers start flowing through, valuations get even more expensive. Stocks does extremely well, and people start forecasting 2-3 years out. I think the same stage is playing out in logistics.
In the portfolios which you manage and the stocks which you own, what are your top 3 holdings, and what do you think is unlikely to change in 2018, irrespective of the market terrain or the macro picture? 3 stocks you've been owning from 3 years and you will not sell for next 3 years.
Yeah, so I think alcohol I continue to be very positive on, both the top MNC names in spirits as well as beer. Pizza I continue to be very positive on. Logistics I will continue to own from here. I think cement looks pretty interesting. I don't think I'll give that away in a hurry. So most of these names I think I'll hold for the next 2-3 years.
Another interesting name, and I remember having a discussion about this with you. A wellness company is what you like, and considering how limited the listed space is, there aren't as many options. You continue to find value there?
Yeah, so I think honestly the earnings have disappointed a bit over there, but I think so if you identify what really went wrong, one is that you need to understand that this is sort of a feel-good play. So you can't be feeling good after demonetization.
Exactly.
You can't be feeling good after the economy freezes after a GST. So you need to feel the ebullience in the economy and people having some money to splash around. I think now both those negatives are behind us. So I sort of underperformed in that name last 1 year. But now that both of these negatives are behind us, I hope that if the economy recovers, people have some extra money and they start spending on these wellness things over the next 2-3 years. Opportunity is huge, and that's what I'm really betting on.
What is the future for names like D-Mart, Trend, Future Retail in 2018? 2017 has been cracker of a year for the brick and mortar retailers, whereas we are migrating more towards e-commerce and online shopping. If I look at the listed companies which are brick and mortar companies, they've had a home run this year.
So I as a policy, I try to stay away from intermediaries.
Okay.
So I like to buy products which are, people want to buy Maggi noodles. They don't necessarily want to buy Maggi noodles from Big Bazaar. Okay. So for me, Big Bazaar is an intermediary. It can do well, but I'm happy to pass on that opportunity, let somebody else make money, because I don't know whether the next consumer of Maggi noodles is going to be from Big Bazaar or from Amazon.
How are you betting on data?
I don't think I'm betting on data. So my point on telecom is very contra to most people's view. I think data is a commodity. the way I'm looking at this is people saw telecom as a growth play from 2003 onwards, and we are still hooked on to that telecom as a growth play. Eventually, what we see happening is that telecom data growth is happening, but the revenue growth for the company is much more.
But you did buy Tata Communication.
I did buy it for a trade. I did buy it for a trade, but not necessarily as a core holding. So my point is that data growth could be strong, but I don't think it may translate into revenue growth. And telecom utilities, both voice and data, eventually will become commodities and utilities.
But that's how technology moves, right? It starts with a promise, then price war kicks in, and ultimately it becomes a commodity. But what happens when a trend is unleashed is that the dependence on that technology or that particular vertical increases higher. For example, I cannot imagine a world without smartphone. I cannot imagine a world without internet or e-commerce. Now data growth is here to stay. So you may not want to buy companies which are providing data, but you may want to buy companies which would benefit because of data consumption. So are you betting on, let's say, buying a Balaji or a Tejas Network or a Sterlite Optic, because the biggest consumption in India is actually going to be data now?
No, so I have not figured out which would be the obvious beneficiary in this. And contra to what you said, so Warren Buffett has gone on record saying this, that airplanes has been the biggest invention, but anybody who bought airline stocks hasn't really made any money.
He's changed?
He's changed, of course. So the point is this, right? So if you don't figure out whether the company is going to make money, you don't necessarily have to jump onto the trend. So honestly, I don't think I've figured out which company would benefit out of this.
I'm looking at your top avoids right now. IT, pharma, NBFCs all make sense, but why private banks?
So just valuation play, right? Okay. So I think at the margin, with such high valuations, I think there are better opportunities elsewhere, wherein the valuations could be similar, but when the earnings turns, that earnings growth would be much higher than what the private banks would produce. So that's a simple argument for not really owning too many private banks, or not owning any private banks.
But you may get right. You may underperform in one quarter, you may underperform for 6 months, but we know that there are legacy challenges for corporate banks and PSU banks which will not go away. Bank recapitalization will only take care of one side of the balance sheet, which is what will happen to their asset. But they ultimately need a business to grow. The culture is broken down, they don't have very superior mechanism, the data, the data collection is quite appalling. So you may see a State Bank of India go from 250 to 400, but on a 2-year time frame, on a 3-year time frame, I still feel that HDFC Bank will outperform in State Bank of India.
No, so don't get me wrong. So I'm not betting on PSU banks either. What I think is at this point in time with these valuations, with the credit growth playing out, it's better to play the credit rating agencies rather than the private banks. So I think when the turn comes through and the credit growth is already at 10%, we would start seeing credit rating agencies start showing much bigger growth than private banks.
What's the big view for 2018? While you've discussed all the stocks and sectors, do you think 2018 could be one of those where the market is going to take in any and every negative surprise, every small or big dip as well is going to be rushed in to buy into, or do you think it's going to be a more sedate market at our hands, more stock specific, you make money but you make money only in select few names?
So at these valuations, the market is not going to be sedate. Either it goes up or it goes down. So the way I'm looking at it, so what I'm seeing is that if you look at psychology or if you look at the positioning, right? So the corporate debt or corporate leverage is very low. Earnings growth hasn't flown through. Interest rates are low. We haven't seen in history a market peak out with all these three factors playing out. So my sense is over the next 2-3 years, we will have to see corporate debt come through as capacities start getting built up. Interest rates will start moving up, inflation will start moving up, earnings growth will follow, and that is where the markets will start getting frothy. I don't know whether it's 2018 or 19 or 20, we will track that. But with these three sets of numbers, and of course volatility being so low, with these 3-4 sets of numbers being adverse, I don't think this is a recipe for the market topping out. So 2018 could be very, very early to looking at market topping out. So we should be bullish. I continue to be bullish here.
Okay, let's look at that consensus, which consensus index projection which Pankaj had just put out in terms of where the street is moving. Now the consensus here is indicating that the index in 2018 could see a move of about 7%. And frankly, I'm with Anant, Aisha, when in disagreement with the consensus here. So in India, you are positioned, like Anant said, we are at a very interesting cusp. Earnings recovery finally has dawned on us, and after a gap of nearly a decade, I think we will see earnings upgrade rather than earnings downgrade. So the wheel is turning. Globally, it's the other way around. US economy could see more downgrades rather than upgrades. The US bull market cycle is maturing. The percentage contribution of US corporate earnings as percentage of GDP is much higher than the averages. US GDP growth is at 3%. It is unlikely to sustain there. So there are two ways of looking at market. If we are in for a global shock, it's going to be a cut and it's going to be a deep shock. If we are in for a local surprise, it's going to be more than 7%. So I don't think 7%. We will not see a swing of 7%. I can easily say that if one thing which will go up in 2018, that is volatility. And typically when volatility will move back into double digit, you will not see a 7% swing. The swing has to be much bigger or greater than 7%.
Yeah, that seems to be the case. And, you know, we can see that wide range of both upside and downside, and the most bearish as well as the most bullish view on the index targets. But Anant, such a pleasure speaking with you. Thank you so much for taking the time out and chatting with us and sharing some very interesting niche sector ideas as well.